Okay, we have to talk about Texas Instruments because they just dropped a reality check, a pretty big one on the entire semiconductor market. And frankly, it's a warning that investors absolutely cannot afford to ignore. In the tech world, there are these bellwether companies, right? The ones that kind of act as a barometer for the whole industry. Well, Texas Instruments is one of the big ones. So when they sound an alarm, it echoes way beyond just their own stock. And trust me, their latest earnings report, it was a major wake-up call. Welcome to the chip market, where we decode semiconductor strategy, tech policy, and investing. Now, let's jump right in. All right, so what exactly got Wall Street so spooked? Here's the thing. It wasn't really the last quarter's results. Those were, fine. No. The real bombshell, the thing that sent a shiver down the market's spine, was the guidance for what's coming next. Just look at these numbers. TI's revenue forecast for Q4 came in around $4.4 billion, which missed what Wall Street was expecting. But the real jaw-dropper was the earnings per share, a 10% miss. Now, in the chip world, a miss that big isn't just a miss. It is a massive red flag. And how did the market react? Oh, it was swift. And it was brutal. The stock absolutely tanked, dropping almost 8% the very next day. So yeah, this wasn't just some minor blip on the radar. This was investors, loud and clear, showing a vote of no confidence. And this really gets to the core of the paradox that's happening in the market right now. I mean, we've all seen the headlines, right? AI chip companies, they're just soaring to the moon. But TI's results? They're telling a completely different story. And it's a story that honestly might be way more important for the actual real economy. So what this reveals is this huge split that's cutting right through the middle of the industry. It's truly become a tale of two very, very different chip markets. Okay, so on one side, you've got the rock stars, the AI and data center chips from companies like NVIDIA. I mean, these things are fueling the AI revolution, riding this insane wave of hype and growth. But then, you have the other side, the workhorses, the analog and industrial chips that TI is known for. These aren't as glamorous, but they are everywhere. They're the chips that power the real economy, your car, the factories, all your electronics. And that side of the market, it's facing a much slower, much tougher recovery. So, what are the experts saying about all this? Well, as you can probably guess, Wall Street is pretty much split right down the middle. The big debate is this: is this just a short-term dip, or is it a warning sign of a much longer downturn? And that's the big question for every investor looking at this space right now, isn't it? Is this a huge buying opportunity, or is it a giant red flag for the whole sector? So you've got the bulls, like the folks over at Goldman Sachs. They're basically saying, hey, everyone calm down, this is a classic overreaction. They see it as a temporary dip. Their take is, if you've got a bit of patience, say 12 to 18 months, this is your chance to grab a fantastic company at a discount before things turn around. But then you've got the bears. Morgan Stanley, for example, is waving some caution flags. They're looking at things like tariff risks and a recovery that's just not picking up steam. They think these aren't just temporary bumps in the road. They're real headwinds that could hurt TI's profits well into 2026, maybe even longer. Okay, but here's where it gets really, really interesting. To truly get what's going on, you have to zoom out. You've got to look past this one quarter's numbers and understand the absolutely massive bet Texas Instruments is making on its own future. This is the absolute core of their strategy. See, TI isn't chasing the AI hype train. They have zero interest in trying to be the next NVIDIA. Instead, they are doubling down, big time, on what they do best, dominating the industrial and auto markets. They're playing the long game here, willing to accept some short-term pain for what they hope will be total dominance down the road. And they're not just talking the talk, they're putting serious money where their mouth is. We're talking a $60 billion plus investment in new fabs, right here in the US. Now, the whole strategy revolves around moving to what are called 300mm wafers. The easiest way to think about it like a pizza. If you have a bigger pizza, you can cut more slices out of it, right? It's the same idea here. These bigger wafers let them crank out way more chips at once, and that slashes their cost per chip by around 40%. The end game here is simple. Control their own manufacturing, bring it all in-house, and build a cost advantage that nobody else can touch. And get this, even with all this short-term pressure, you can still see just how strong they are. Look at their operating margin. At 35%, it's still way, way ahead of their big competitors like Analog Devices and NXP. This is the foundation they're building on. They're already an incredibly profitable company, and this whole long-term plan, it's designed to make that lead even bigger. Okay, so let's bring it all together. What are the key takeaways from all this? What does TI's report really signal for investors, not just in chips, but across the entire market?
I think there are three really big things to pull from this. First, the recovery in the real economy, the part powered by cars and factories, is a lot weaker and slower than people expected. That's clear. Second, TI's massive spending on new fabs is a brilliant long-term move, but in the short term, it's definitely putting a squeeze on their margins and cash flow. And third, and this is maybe the most important one, TI's results could be a huge warning sign, a real canary in the coal mine, that the economy outside of the AI boom is starting to slow down.
And that brings us right back to the central question, doesn't it? Is this warning from Texas Instruments a generational buying opportunity to get into a long-term winner, or is it a major economic red flag that we should all be paying very close attention to? That's the billion-dollar question. Hey, if you found this breakdown useful, do me a huge favor and smash that like button. It really, really helps the channel out. And I really want to know what you think. Drop a comment below. Is TI's warning a buying opportunity, or is it a sign of bigger trouble ahead? And of course, don't forget to subscribe so you don't miss our next deep dive right here on the chip market. Thanks so much for watching.